Welcome to Riverus. Here to talk with Vijay Shah, practitioner of income tax. And he has recently argued the case of VIthal v. Kamat versus JCIT, which has been decided by Mumbai ITAT. And the main question in this case revolves around how should one treat the received monies that have been received by a retiring partner in a firm. Maybe I can begin by asking you to give me a little bit of details about your work, what kind of matters you advise upon, and your how you came to deal with this particular case.
Sir, I am attending the cases since last 40 years for income tax before tax authorities. Wherever I find a problem, and first of all, we see the legal issues, whether the notices have been issued properly or not. If it is a reopening of the case, the notice under 148 has been when the regions have been recorded properly or not. The sanction from the authority stamp is there or not. When the date of the issuing the notice is proper or not. So all this aspect, first of all, we see whether the department before the issue has taken the proper steps, has recorded properly, all the things have been done, and their homework is proper. Then only we go for the legal issue. This is a technical.
So, could you briefly explain how this case landed in the ITAT Mumbai?
Sir, what happened during the course of the assessment proceeding? I was present at that time. And I was present at and we explained the amount received from the partnership firm on the retirement. Mr. Vital Kamat has given the notice for the retirement. It is a public notice which was prepared by the solicitor. Which was prepared by the solicitor, very famous solicitor. Not only it was not famous only solicitor. There is no scope for this making an application of the McDowell case. And the firm was continued since 1992 next. It was, and we have retired after 16 years. How the case of the McDowell can be applied? And whatever amount there in partnership firm, there are two aspects. There, in partnership firm, there may be a movable property, there may not be a movable property. If capital asset deficiency, there must be a property assets, etc. Fixed assets, etc. If I'm a partner in the chartered accounts, there is no immovable property. How the section 45 can be applied? There is no capital asset at all. So there is a discrepancy between this part. So when we are studying all these cases, we have when the case has come, from 19 it came 2008 when we got the amount. Here is a discrepancy between in the partnership act and a firm. If firm has got a property, immovable property, then the capital gain. When if firm doesn't possess any capital asset, more land, building, etc., then how the firm any retirement benefit can be treated as a capital. There is a capital gain. So charging section 45 one was failing, sir. And not only that, if there is no immovable property, land and building, etc., so capital asset definition also fails. So all these aspects we studied when we have details, sir. We we were aware of that we shall win the case. During the course of the appellate proceedings, we argued all these cases where in the Supreme Court, in the case of the Mama Bhai, L. Raghu Kumar, etc., we have studied it. In definition itself, it covers the amount received on the retirement. It is not a taxable, and they have stated before that section 47 2 and 3 at the there. So and the amount received on the retirement is not taxable. Because later on, whenever the amount and there will be a reduction of the firm, they can tax it. And so therefore, at that time, and event was not occurring at the time of the refund. Event was not occurring when the capital asset has been departed from the firm to other persons who has got a right in the property. Firm has got a right in the property. So how it can be taxed in the hands of partner? So see, this issue has been argued before the commissioner accepted. Not only that, there was a one one lacuna by the assessing officer. He has the cost of acquisition has been determined nil. When there is a cost of acquisition nil, there is machinery under section 48. Sir. They cannot. In the Bombay High Court, in the case of the Dhaka Enterprises, etc., Bombay Tribunal has held that when there is any considered nil or negative, any cost of acquisition nil or negative, machinery under section 48 fails, and therefore there cannot be capital gain. Even we have studied one example also. Although Maharaja, they have got a land. At that time, the value is taken as being nil because they have got it as a zamindari. In that case, also many high courts said that there is no capital gain. Not only the we have studied the buffalo cases. In buffalo, if they give buffalo and cow cases, if they calf born, it cannot be never be treated as a capital asset. And the soul of the calf cannot be and cannot be bring a capital cannot be bring as a capital gain. Therefore, all these cases are we have studied where when there is a an ultimate source is we have received as a capital receipt. Bacha as Gazdar can be applied. Ultimate, I am receiving as a amount from the retirement of the firm. I am not receiving the sale of the firm. Ultimate note should be there. Bacha as Gazdar, ultimate source should not be seen. Therefore, apparently, it is a apparently, therefore, we have studied about cases. We argued very well and explained all these cases. And first of all, it will be argued by the department because it will be thereafter.
Sir, if I understood, there are two arguments. One argument was that the money that Mr. Kamat has received on retirement cannot be brought to tax because it's a money that it is in the nature of capital receipt, and there is no question of capital gain coming into play. And you also raised an alternate argument that if the cost of acquisition is nil, then the machinery provision fails, and therefore the charging provision for capital gain must also fail. So these were the two broad limbs of your argument.
Yeah.
Right, sir. Sir, I want to come to the first question, which is where the money that the retiring partner has received cannot be brought to tax by way of capital gain over here. I think there were two complexities that the revenue introduced in this case, or their main argument was that there were other partners in the project or in the partnership firm who had paid capital gains tax on account of transfer of their share in the property. And similarly, they also on the same footing, they sought to hold that when Mr. Kamat got the 48 odd crores, then it must be also treated along the same line that it is nothing but transfer of development right and transfer of possession, and that should be capital gains. How did you deal with this argument, sir?
Sir, the other partners have paid the taxes at their own. I cannot control their returns, sir. They are not under my control. They want to buy the piece by paying the tax. I cannot say that you should not pay the tax. Otherwise, when they have introduced land, because they have introduced the land, we have introduced the 1 crore 50 lakhs, sir. When they introduced the land, at the time they have paid the tax by following the case of the 156 item has been negated, and there is a change in the act from 1987, sir. Because any land or building or capital asset has been bought into partnership firm, there is the capital. On their same amount and on 1 crore 50 lakh, all the partnership were the taxes. So when they have transferred this property to partnership firm, the right has been and whole land belongs to the partnership of forceful construction only. But to buy the piece, because they are very old in advanced age, to buy the piece, and therefore they have paid the taxes because it was very negligent amount to them, so they have paid the taxes. I mean, they have transferred the property at that time they have paid, and they want to buy the piece, sir. So we cannot control them, and if they have paid the taxes, the law should not be forced. If the other person has paid the taxes, so you should pay the taxes also. Law, then law should prevail, sir. But if other partners have erroneously paid, what I can do, sir? It is not my mistake, na.
Right, sir.
Second aspect, it was not a sham transfer. The documents have been prepared by the learned solicitors of the Bombay, sir. It is so. Therefore, this this learned solicitors. Therefore,
Kangan company, sir. Yeah.
there is no. But we have given the public notice in the newspapers. All the liability and have been rights have been relinquished by me. So there is no question of the sham transaction, sir. It is open. If by sham transaction, it may be under table, under carpet, everything is there. Then when open transaction, it is public notice. How can transaction can be treated as sham, sir?
Sir, could you explain after the both sides argued in before the tribunal, what was one or maybe 2 points that really went in favor of Mr. Kamat, and where the court really thought that this is on this particular ground we should give the case to the assessee. So if you could identify one or two grounds amongst all the others that were argued.
So there, the main argument is that DT was received from the directly from the donor. First of all, their argument. So when I am losing the control, when I am retiring from the firm, so who become the partner, who do not become the partner, I don't know. And whether directly firm has been paid to me or not paid to me, I have received my amount for the consideration. I am very happy. So there is no question any receipt of the money from anywhere, any how related to time renewal group. I was not knowing. So I have received the money. I am satisfied. I was happy. So there is no their argument is it is not rooted to the firm. So it cannot be treated as a valid retirement. So we argued that we have lost control when we have retired, sir. So it is was in their hand how to deal with. So first of argument and second aspect, if it is to be taxed, it should be taxed in the hands of the firm, not in the hands of us. We have retired. We have not transferred. The firm has transferred the property. So it should be taxed in the hands of the firm, not in the by the. There are a number of cases tax in the hands of the firm. So we have we are knowing we will win the case. There when we are preparing before the CIT also, we argued all these cases and we have prepared. The consideration is nil. Second aspect, there is no sameness. If income tax officer wherever go, you even you claim under 80, then also they will treat it as a sham transaction. And it is the nature. So one mate is to be written everywhere. Whenever they show that there is any tax saving there, so they will write it is a sham transaction, bogus transaction, etc. It is their nature because they are working as a one of the court against us, any SSC. So therefore, it is their contention, sir. For all transactions which are in the public domain, done by the banking channels, everybody is known, everybody PIN number is there. So how it can be treated as a sham transactions? So we were knowing it is a genuine transaction, it is well built, and there is no transfer by the partner. There is a transfer by the firm. So how it can be taken in the hands of the partner? Second aspect, the consideration cost of acquisition in nil. That both aspects have been dealt by the Supreme Court. So there is no question at all. My
Sir, one thing that is coming out from your conversation, and I would summarize that, and one thing that you mentioned repeatedly, that it was a public transaction. Mr. Kamat had given a public notice of his retirement from the firm, so it was not a transaction which was done in hiding or that people didn't have notice of it. It was documented by solicitors of high repute, and you believe that one of the reasons that the court looked at and accepted the arguments that you put forward was because this transaction was a very public transaction. There was no attempt to hide it. Public notice was preferred. Documents were prepared after prolonged negotiation. And therefore, you believe that all the other arguments that you made were bolstered by the factual aspect, which is that it was a very, very public transaction. Is that a correct statement, sir?
yes.
Right, sir. Sir, I will. What's your view? What is the advice that you will give to taxpayers in future about the adequacy of documents, especially in the era of faceless assessment, and faceless appeal that we are entering into?
Yeah. So all these aspects you have to study how you are dealing with. And you have to explain first of all, and all the documents as if you are preparing a transfer pricing. As far as transfer pricing is concerned, when your audit is concerned, you prepare all the documents, cup method, whatever method is 13 whatever method as you are following, you are keeping. Otherwise, there is a proper documentation that there is a penalty in the case of transfer pricing. So we have to think that this is transfer pricing case. We have to prepare ourselves and we have to argue prepare. Then only we can prepare. Second aspect, as per the trace association there. You have to read the query properly. And you and never give the reply that you fully answered or fully replied. You whenever you submitting your query sheet and etc. I'm assessing officer, you partly submitted. So they will not make their assessment final. Otherwise they have to issue the notice, focus notice. You are not completed the assessment. So you get the time also. And first of all, you prepare yourself as if you are the other person is what many times what happens, sir. I I ask the assessee also treat yourself as a assessing officer. If you satisfy that you as a assessing officer you are capable of allowing the appeal, then only you do it. Otherwise you are going to lose the cases also.
So the final question, in this era of faceless assessment and faceless appeals, there would be a lot of emphasis on replies which are convincing in nature. Given the opportunity of personal advocacy may not be available in every case. Now, do you see in such circumstances seasoned practitioners like you who have practiced for decades and who have handled many complex cases being able to handle matters that may be from various parts of the country, may not be from your immediate client circles, but the other chartered accountants who need now the expertise of explaining their replies in a convincing manner to the department and then to the CIT appeal when this appeal stage goes. Do you see that your practice increasing and broadening given the experience that you have gathered over decades of income tax practice here in Mumbai?
At that time, they were dealing with the commission etc. directly. That this dealing will be stopped. And if your documentation is proper, your documentation is there, your accuracy is valid, there is no harm that if the issue is lower than the 50 lakhs, the department will not go to the ITAT. If you are assessing, you are losing the case, then you for the any amount you go to before the ITAT. That this case will be determined finality at the IT only, because wherever where you are going to submit your documentation, paper book, etc., case law, which will be studied. Here in Faceless Assessment, I submit a case law also. Whether concern IT has studied or not, I also don't know, sir. So it will be all these issues are there. And there will be all these issues are there, but we have to answer properly.